Rob's Child, nothing I say is investment advice. Welcome back to the series where we review every chapter of Benjamin Graham's The Intelligent Investor, revised edition from 1972. Today we're going to go over Chapter 9, Investing in Investment Funds. I assume that you've read the chapter. Remember, this series is to review this book, the material in this book, to talk about it a little bit, to see how the lessons may apply to what's going on today in 2024. I will also provide some insight as to how it might relate to some of the information from security analysis. This chapter didn't have a lot in that regard. Again, if you want to read, if you don't know how to find the book, there's a link to the book below. There's a PDF format of the entire book online. Just use the link below. It's the same edition that we're looking at in this series. Again, today's chapter, Chapter 9, Investing in Investment Funds. Overall, this chapter is not super relevant to what's going on today, but I think it's good to pull a few points out of it. We'll go through the main points. This is probably the least useful chapter out of the whole book, at least so far. But let's see what we can get out of it. So, what I was getting out of this was it's mostly basically about mutual funds. If you know anything about investing today, mutual funds are becoming more and more antiquated. Most investors tend to use ETFs now, exchange traded funds, and it's because they're extremely liquid. They're so easy. They trade like a stock during market hours. You can get options contracts on them. One supposed conservative way of using them is selling covered calls. It's what a lot of retired people, slightly more active investors, will do. And then a lot of money managers today will use the ETFs themselves to manage people's assets. It's just so efficient and so good. I don't think they existed in the time of this book in 1972, and it would be amazing to see what he would say, how he would think of ETFs today. He would be, if he knew that these were coming in the future, I think his mind would be exploding. But anyway, let's get through the chapter. One point saying with mutual funds, there's the tendency to misprice things and cause mispricing. I think this has to do with large mutual funds, basically, over-investing in certain things and causing mispricing. Just one of the things that can happen, if you think about it, with securities in general. If you're, for example, like an innovator, you're a part of an innovation company, right? And you didn't get into Cathie Wood's ARK funds. Well, you're gonna not have the kind of premiums that we're seeing, especially during COVID, that we're seeing in her holdings of her funds, because they got so popular and people, put so much money into them. They performed very well. It's very well known funds. So I relate to that going on here. And I also wonder, like, for example, Warren Buffett's Berkshire Hathaway, his A shares and B shares, from my perspective, that's partly why Apple has had such an overvaluation. And funny enough, he's actually sold some Apple stock because he sees the valuation. Warren Buffett knows Graham's work very well. He bases his success on this guy's work, but Coca-Cola as well, Graham would likely, I think, see a lot of valuations today of companies as being overpriced, and partly because of what happens with these funds. Including, I would say, even the S&P 500, VU, or SPY. These are market cap weighted indexes that have to hold the same amount as the market cap weight that it has in the index. And so I think that part of the overvaluation in the mega caps that we're seeing today is this effect here, the tendency of funds to sort of continue mispricing it. The bigger it goes, the more people have to invest in it because it's bigger. I think that might be what's going on here today in 2024 with these mega caps. Anyway, to continue through the chapter one, I'm not going to go through a lot of the details because, again, a lot of this is irrelevant to what's going on today, but just going to go through what I think is worth going over. One thing he mentions in here is the French famous phrase, the more things change, the more things stay the same. The French version, plus ça change, plus c'est la même chose. Something like that. I don't know. I forgot how to pronounce French. So he's referring in this section to like hot new funds from like young people. Always, it always seems great at first. And I mean, I think, again, the lesson that I get out of this more so is that, like, just be careful of things that are getting popular, anything that's getting popular. We've seen, silver several times in the past get unbelievably popular. All of a sudden everybody wants silver, and you have like millionaires cornering the market and just skyrocketing the price, and then it always ends the same. And anything that gets overly popular, overly valued to normal business valuations and to history, they tend to go the other way. I'm very curious to see what's going to be happening with Bitcoin, going into the future. What kind of value it will have, what retain, go down to, that's one of the more interesting markets. But again, this is one of those things that relates to this. It's like, especially when Bitcoin's at all-time highs and people keep chasing it higher, that to me relates to this, as in, like, this is the hot thing. This is the tulips, from hundreds of years ago. If you don't know about tulip mania, look that up. Or the silver squeezes, how silver went so incredibly high several times in more recent history. But anyway, this is more about stocks, and and so right now Nvidia, having so much crazy value in it. Meme stocks too, which is that one's like the easiest example to see how that works. How, like, something, not even a fund, just a way of thinking, like, whatever's popular, like, yeah, we just like it, and then it goes up, and then the managers of the company are like, okay, yeah, here's some more stock, making, just this whole meme stock craze has just been one of the craziest things that has ever happened in markets, in my opinion. But we're going to move on through the chapter. So one good point that he makes is smaller size is a necessary factor for obtaining continued outstanding results. And this is one of the frustrations that Warren Buffett himself brings up. He says that Berkshire Hathaway, for example, one of its problems is its size. And this is what Graham is talking about here. When you have a fund that is so ginormous that they can literally eat up $100 million, $1 billion companies, like a Pac-Man is like, they can own the whole thing. It's like, you're not going to get the kind of advantages that you can get as a smaller fund that is more carefully picking certain things and can only buy partial parts of it and just wait for the market to move it around. So the smaller size aspect, as far as like more managed type funds, is going to be a useful attribute. Smaller size. Funny enough, like, this reminds me of the uranium industry and how frustrated actually uranium investors are today because of the ETFs, because of the, they can't get an advantage because of the funds themselves. Again, mispricing the value. Like, some companies probably don't deserve as much value as they're getting because they're part of funds that people are buying. That's all what this chapter is all about. Moving on, we have big ups mean big downs. So that which goes up must come down. It's a physics thing, right? All right, and then he says, try to find funds at a discount to NAV, the net asset value. So, the way it works is a fund owns a bunch of pieces of companies, and sometimes the value of the shares of the holding company, so whether it's the ETF or a mutual fund or any kind of fund, they can actually be selling their shares at a discount to what they actually own sometimes, or they could be selling at a premium to what they actually own. This doesn't happen often today, at least not very much, especially with ETFs. In his example, he says that you can find more of a discount in closed-end funds, but he does warn in here, okay, yeah, you can get a discount, but you don't know how long it's going to be at a discount. And he goes through charts and examples, as you can see in the book, obviously. But this doesn't really relate to today very much. So it's like I said, this whole chapter is not doesn't have a ton to offer to the modern investor. But anyway, moving on, says that open funds sell at a premium, and he just sees that as more of a problematic thing. If you're paying more than what the holdings are of the fund that you're buying, I think he just doesn't like the idea. But yeah, he goes through a chart how that over time the premium can go up and down basically, and he prefers the discount. I think it just gives him that feeling of safety more than anything. But also performance wise, I believe he found that discount to NAV, you're going to do better over the long run. Again, it's not much of an issue today, but when you do find discount or premiums to NAV, I have found this in the past for arbitrage situations. The greatest example was Grayscale Bitcoin Trust. So this was a fund that before they became an ETF, I believe I don't know what's going on with it right now, but previously they were in a situation where they were a trust, and so the holdings of Bitcoin that they had, when Bitcoin price was shrinking, people were selling out of the fund faster than people were selling out of Bitcoin itself. And so what you had was the value of the shares of that symbol, GBTC, were lower. They were selling at a discount to the Bitcoin that they added, and it was a significant discount. I don't remember the number exactly. I think it might have been around even 20%. But knowing that this fund has traded at a discount and a premium in the past, it became an obvious great opportunity. The best way to get into Bitcoin. You're literally buying Bitcoin at a discount at the lowest price that it's been for a while, and that was a very exciting opportunity a year or two ago when they were still a trust. But anyway, so any opportunity you can find with arbitrage regarding premium or discount to NAV is a great situation. Next point, the last point, I guess, is he says the bonds in a balanced fund aren't worth it. I think mostly because of the fees involved. Bonds as a whole don't pay that much to begin with. Just seeing the yields are low, and they don't increase over time, and so the fund chipping away at the profit that you can make because of its charging for it. He says better to get your own bonds. Basically, it's not that hard. Just do it. Is the lesson that I got out of that. And again, it will overall, for the theme of this chapter being about investment funds, I really am so curious what Graham would say today about his thoughts with ETFs. Maybe we can get an AI generator to compose a piece using all of his work, and how would he see ETFs today and how they work and how they all fit together. It would be great, but he's not. So this is what we have. Hope you enjoyed this chapter 9, investing in investment funds, and I'll see you in the next one for chapter 10. Thank you for watching. Hope you enjoyed watching. See you next time. Rob's Child.